Hi, everyone, and welcome to the next LSX Investival Masterclass hosted by Pinsent Masons regarding IPO readiness. Before we get started, just a couple of admin points to make sure that this masterclass runs as smoothly as possible. We do have a presentation, as I'm sure you can see, but if you have any questions throughout, if you can make sure that you ask them in one of two ways. First of all, you can ask them in the chat function at the bottom of your screen. Alternatively, and you want to wait, you can reuse the raise hand function, which if you look at the sort of toolbar, again, at the bottom of the screen, it says reactions with the smiley face. If you click on that, there is an option to raise hand and a little hand will appear in the top corner of sort of your video screen. And we will obviously get to any questions or people that look as though they want to ask a question as quickly as we can. So that's enough from me. You're certainly not here to listen to myself speak. So I will hand straight over to Julian to get the masterclass started. Julian, over to you.
Thank you, Becky. Good afternoon and welcome to this IPO Readiness Masterclass. So my name is Julian Stanier. I head up the corporate finance team at Pinsent Masons, and I'm joined today by my colleagues Charles Waddell, a partner in our life sciences team, Roberta Markovina, who heads up our US securities practice, and Sanjay Malhotra, a corporate senior associate in our life sciences team. So whether you're considering a listing in the UK, Europe, or the US, it's critical for your company to be prepared for what the IPO process actually involves. And we're going to explain what exactly being IPO ready means today. We'll provide you with an overview of some of the considerations involved when you decide to embark on an IPO. And we'll also give you an introduction to some of the technical aspects of the IPO process in the UK and on Nasdaq. Just as a heads up, there's a lot of detail on some of the slides, and we don't propose to go through all of the detail, but we will be making the slides available to you after the event. So we're happy to follow up with people if they have further questions. And as Becky's explained, to the extent we have time at the end, please do sort of put in any questions and things, and we'll do our best to answer them. But otherwise, our contact details are set out at the end of the slide deck, and we'd be happy to follow up with you. So by way of introduction, for those of you who don't know Pinsent Masons, we're a national and international law firm, and we have a vision to be an international market leader in our global sectors. One of those, and very key to the firm, is life sciences, and Charles will talk a little bit more about this in a moment, but in life sciences, we have a tier 1 ranking for our team. In terms of our capital markets practice, again, we're a top-ranked team for small cap and mid-cap ECM work. As you'll see from the slide, we've won many awards, have tier 1 rankings, and lots of accolades to our name. But for me, the proof is in our work. And in the first half of 2021, we've advised on and completed more IPOs in the London market than any other law firm. I'll now hand over to Charles, who's going to talk a little bit about our life sciences practice. Thank you.
Thank you, Julian. Hello, I'm a corporate partner on our transactional life sciences team, and I advise startups, private companies, and listed companies on a wide range of corporate finance, public listings, and M&A transactions. We have a team of 100 lawyers in the life sciences team who advise on a wide range of matters. In addition to corporate finance and M&A, we advise on licensing and partnering, IP, patent litigation, regulatory matters, and reimbursement. On the slide, you can see some logos of some of the clients we've acted for in the last 12 months. If I had to pick some recent highlights, I would select the work we've done for the vaccine task force, who we've advised on buying the Pfizer-BioNTech vaccine for the United Kingdom. It's rare that a law firm can claim to have worked on a transaction that has moved the FTSE 100 and FTSE 250 indices. We've advised RedX Pharma on its 420 million target-based research collaboration with Jazz Pharmaceuticals to discover and develop 2 targeted cancer therapeutics. I've advised on the sale of Lidco and Oxgene, and we've also advised on the sale of Huntsworth. We've advised Activus, a subsidiary of Teva, on the sale of a suite of consumer healthcare products. We've advised 4D Pharma on its research collaboration and option to license agreement with MSD to discover and develop live biotherapeutics for vaccines. I've also advised 4D Pharma on numerous placings and its acquisition of a SPAC, and by which it acquired a secondary listing on NASDAQ. And finally, we've advised a slew of listed and unlisted biotech companies, including 4D Pharma, EvGen, OnCommune, Angle, F2G, and eTherapeutics on financings. I'm now going to ask Sanjay Malhotra to take himself off mute and to take us forward.
Thanks, Charles. So let's start from the beginning. You're considering taking your company public. What do you need to know? So the first thing you'll need to do is consider the relative pros and cons of going public and how they fit with the circumstances of your company. On this and the next slide, we've set out some of the advantages and disadvantages of going public. So these will apply regardless of the market that a company is looking to list its shares on. Advantages include things like access to capital. So being listed arguably makes it easier to raise money in the future. Obviously, having access to cash is key for all companies, but particularly for companies in the life sciences sector, what with the cash burn rate associated with R&D activities. Liquidity, so a listing means company shares are more liquid and tradable, making the investment more attractive to investors than an investment in a private company that may have certain restrictions on how and when you're able to transfer your shares. A listing also increases a company's public profile, both the fact of being traded, but also because of the disclosures that a public company is required to make. Obviously, the flip side of needing to make disclosures is the loss of privacy, which can sometimes come as a shock to companies that have been private for a long time. A listing also brings with it greater accountability to shareholders, something which is obviously not a bad thing per se, but it does put management decisions under the spotlight. And a big one, there'll also be a certain loss of control. So significant acquisitions and disposals may require consent of shareholders, and there could be pressure on management to maximize short-term performance, sometimes at the expense of long-term strategic goals. So these are all things to consider in the round. But the all-important question is, which market should I list on? So choosing the right market will depend on a number of different factors. So you'll need to consider things like the stage of your company's development, a relative size of the company, access to potential investors. So certain institutional investors could be restricted from investing in securities on certain exchanges. Think about the anticipated price performance and liquidity of your securities, relevance to a company's business. So is there a particular reason to raise a company's profile in a particular jurisdiction? For example, if you're looking to get products approved by the FDA, does it make more sense to go to NASDAQ than stay in Europe? Entry requirements. So certain exchanges may have more stringent entry requirements than others, for example, with regard to things like trading record or management or minimum market capitalization. And finally, and this is where you've got to look beyond the actual listing process, the level of regulation and degree of disclosure that's going to be required by a particular market once your shares have been admitted to trading. So let's start with London. The London Stock Exchange's two principal markets are the main market and AIM. Both markets are open to the UK and overseas companies. There's a two-stage admission process for companies who want to have their securities admitted to the main market. The company must first apply to the Financial Conduct Authority for its securities to be admitted to the official list, and apply to the LSE for its securities to be admitted to trading on the main market. The main market itself has two segments, a premium segment and a standard segment. A premium listing requires an issuer to meet what's called super equivalent standards, which are actually more onerous than the EU minimum requirements. And a premium listing also requires companies to meet the UK's highest standards of regulation and corporate governance. And just to add, a premium listing is also a prerequisite for admission of a company's shares to the FTSE indices. So each of the premium segments and the standard segments have slightly different eligibility criteria and continuing obligations. For example, a company only requires a sponsor if it has a listing on the premium segment. For both premium and standard, at least 25% of a company's securities need to be in public hands, which is the free float requirement, the bottom bullet on this slide. Also, the main market listings, companies from main market listings need to have a 3-year track record. A technical point, but companies looking for a main market listing also need to have a minimum market capitalisation of £700,000. So while that is a technical requirement, the question that a company must discuss with its financial advisor is what level of market cap do we actually need to gain sufficient attention from analysts and from investors in the market more generally to ensure there's sufficient liquidity in the market through the trading of a company's shares, such that a large sale doesn't drive the share price down. Because the fact is, without the correct profile and resulting liquidity, any secondary issue of shares to raise money becomes a much more difficult sell to investors. On the premium segment, non-UK incorporated companies also need to have more than 50% free float for inclusion in the FTSE indices. AIM, on the other hand, is a market for smaller and growing companies which might not meet the full criteria for a listing on the main market, or for whom a more flexible regulatory environment might be more appropriate. So the entry criteria for AIM, some of which is set out on this slide, means you can gain admission without a trading record. There's also no minimum size or free float requirements or number of shareholders, unlike on the main market. Companies applying to AIM have got to appoint and retain a nominated advisor, or nomad, who will be able to guide it through the admission process and also be able to advise the company subsequently on its compliance with the AIM rules. AIM itself is an exchange-regulated market, which means it's operated by the London Stock Exchange. AIM companies benefit from a more flexible regulatory environment that can act as a stepping stone for those companies that may aspire to the main market or even to a listing on NASDAQ. Also, it's worth mentioning that there's certain tax incentives associated with being listed on AIM, such as an exemption from stamp duty on share transfers. So individual investors won't have to pay stamp duty, and that therefore enhances the attractiveness of investing in companies on AIM. Companies that have got their shares listed on AIM range from young and VC-backed businesses to more established businesses that are looking to expand. AIM's a diverse market. Companies are admitted from all business sectors and from all over the world. The advantage of AIM is that it offers the benefits of being publicly traded, but within a regulatory environment that's specifically tailored for smaller companies. Euronext Amsterdam is an EU regulated market. So the minimum market cap to get onto Euronext Amsterdam is €5 million, with a free float of 25% or more. An issuer needs a listing agent at the time it admits its shares to Euronext. Trading history requirements on Euronext are actually less stringent than on the main market because you only need 2 years of audited financial records. On Euronext, there are 3 listing compartments, A, B, and C. Compartment A is for those companies with a market cap in excess of €1 billion, and Compartment C is for those companies with a market cap of up to €150 million. There's also, apart from Euronext Amsterdam, various junior markets around Europe, such as Euronext Growth and Euronext Access. So Euronext Growth, the average market cap of companies there is around €97 million, and Euronext Access, it's around €51 million. Unfortunately, our Euronext expert can't join us today, but if you do have questions or want further information on Euronext, please drop any one of us an email and we'll put you in touch with the relevant people at the Pinsent Masons Amsterdam. It's just worth saying as well that it doesn't matter which of these markets you choose to list on, because you can raise money from investors anywhere in the world, particularly in the US. And Roberta's going to talk a bit about that now.
That's right, Sanjay. The US does have a deep pool of life science investors and potentially the deepest in the world. But access to US investors is not limited to IPOing on a US securities exchange. Companies listing on the main market, on AIM, and on Euronext can also access high quality US investment. So offers and sales of securities in the United States must either be registered with the Securities and Exchange Commission, the SEC, or exempt from registration. So we'll talk shortly about the NASDAQ listing criteria and the SEC registration process in the United States, but companies can access US investors by including, as part of their IPO outside the US, a private placement into the United States. So this would typically include offers and sales being made pursuant to an exemption from the US registration requirements to certain sophisticated investors called qualified institutional buyers, which are entities that own and invest on a discretionary basis at least 100 million in securities. In addition, it's worth noting that many life science companies have commenced their life on AIM and then migrated to the NASDAQ as their businesses have evolved or their nexus to the United States has strengthened through, for example, an FDA application process. So the advantages to this are twofold. So as Sanjay had touched on, in that it offers a company an opportunity of being a big fish in a small market, and also the fundraising opportunities that follow that, and also exposing them to the obligations of being a public company without the increased liability of being listed in the United States. So many companies do look to list on the NASDAQ, which has been the venue of choice in the US for life science companies. The NASDAQ hosts 98% of the US listed biotech or life science companies. And the NASDAQ has over 1,000 listed healthcare companies. And over the past 5 years, NASDAQ has had 167 biotech and pharma IPOs that have raised between 50 and 150 million, and 102 IPOs that have raised greater than 150 million. So the NASDAQ is regulated by the SEC and the Financial Industry and Regulatory Authority, also known as FINRA. To list on the NASDAQ, a company must be registered with the SEC and register the IPO shares with the SEC. The NASDAQ has 3 tiers, so the NASDAQ Global Select Market, the NASDAQ Capital Market, and the NASDAQ Global Market. The initial listing criteria includes financial and liquidity requirements, as well as corporate governance requirements. So the financial and liquidity requirements are more demanding as you move up the tiers, with those for the NASDAQ Global Select Market being the most stringent. The corporate governance requirements are the same across all of the tiers. The initial listing criteria for the NASDAQ is quite different from the requirements for other European markets. So each of the NASDAQ's 3 tiers offer at least 3 ways to meet the criteria that address different financial characteristics, but all with an eye towards liquidity. So here we've set forth the financial and liquidity criteria for the NASDAQ Global Market, which is the middle tier, to give you a flavor for the initial listing criteria. As you can see, there are 4 standards that a company can rely on, depending on their income, equity, market capitalization at the time of IPO, or total investments in revenue. But all of the standards require a company to have at least 1.1 million unrestricted publicly held shares and to trade at least $4 a share. So similar to the 25% free float requirement for the premium segment on the LSE, which Sanjay mentioned, each of the 3 NASDAQ tiers requires a minimum number of unrestricted publicly held shares to trade. So securities that are not registered with the SEC as part of the IPO or otherwise, and securities held by affiliates, so being officers, directors, and 10% or greater shareholders, hold what are called restricted securities. And these securities are not freely transferable or freely resaleable and will not count towards the unrestricted publicly held share requirement. So to the extent a VC backer does not sell as part of the IPO and is considered an affiliate, they will hold restricted securities and must either be registered with the SEC at a later date or sold pursuant to an exemption from registration, for which there can be onerous volume and manner restrictions. Consequently, they may require registration rights, which we'll touch on later with Julian. In terms of the other tiers, the initial financial and liquidity requirements are strictest for the NASDAQ Global Select Market. And because of this strict criteria, to be included in this tier is an indication of the company's international stature. Companies must have and meet the criteria for earnings, capitalization, or assets, and have at least 1.2 million unrestricted publicly traded shares and trade again at least $4 a share. So like AIM, companies on the NASDAQ Capital Market, the lowest tier, are focused on raising capital and therefore typically are younger with less liquidity and revenue than the companies listed on the other tiers. So they must meet an equity market value or net income standard and have at least 1 million in unrestricted publicly held shares, and like the other tiers, trade for at least $4 a share. So a copy of the financial and liquidity requirements for each of the NASDAQ tiers is linked in the slides that will be circulated after this section, so at the bottom of this slide here. So Sanjay will now take you through some of the different types of listings on the UK market.
Thanks, Roberta. So The type of offering document will differ depending on the exchange that you're looking to list on. So on the main market of the LSE, the offering document or prospectus needs to be vetted and approved by the Financial Conduct Authority, whereas on AIM, it's the nominated advisor who's responsible for declaring a company's suitability for listing on AIM. As well as the entry criteria, you'll also have to think of ongoing obligations to which your company will be subject following its listing. It's worth saying that whichever of these three markets that your company chooses to list on, it will be subject to the market abuse regulation relating to the disclosure of inside information. So this is an ongoing obligation, and the ultimate purpose of it is to promote prompt and fair disclosure of information to the market. This means that there will need to be a continual assessment once the company is listed of what does and doesn't constitute inside information. Companies with a premium listing, as I mentioned earlier, are held to the highest standards of corporate governance, namely compliance with the UK Corporate Governance Code, or to the extent that a company can't comply, it will need to provide an explanation of how and why it doesn't comply. While there's no specific requirements on AIM, the expectation is that AIM companies comply with the QCA code, which is the Quoted Companies Alliance code, which is essentially a watered down version of the UK Corporate Governance Code. Shareholder approval could also be required for significant transactions on the premium segment and on AIM, and the process for each market in terms of getting that shareholder approval is slightly different. No such approval would be needed on the standard segment. Announcements and shareholder approval requirements are dependent on various class tests which assess the relative size of a transaction to the size of a company against, for example, its gross assets or its profits. Similarly, the requirements around raising money should be front of mind for you going forward when choosing which market to list on, because companies, particularly in the life sciences sector, tend on average to raise money every 18 to 24 months on average. So you need to think about what is going to offer you the most flexibility in that regard. Generally, subject to approval at your annual general meeting, a company will be able to raise a certain percentage of its issued share capital without having to go to shareholders for approval. There's more flexibility as to what that percentage is on AIM, where you often get around 40% of your issued share capital. But on the premium segment, anything more than around 20% requires the convening of a general meeting and shareholder approval. So if you anticipate needing to raise substantial funds in pretty short order, it may be that AIM and the flexible regulatory environment that it offers is more suitable for your company. Roberta is going to walk you through some of the registration and ongoing reporting obligations now in the US.
Thanks, Sanjay. So when a company IPOs in the United States, it will register the shares being offered with the SEC by filing a registration statement, apply to list the company on the NASDAQ, and will thereafter become an SEC reporting company, meaning it will become subject to the ongoing reporting and disclosure obligations under the US securities laws. And this includes compliance with Sarbanes-Oxley. So Sarbanes-Oxley is an act that is aimed at the fair presentation of a company's financial statements and the maintenance of effective internal control systems to monitor financial reporting, and requires certain certifications of the company's CEO and CFO, for which there can be criminal liability. So whether a company is considered a foreign private issuer or a domestic issuer will drive its reporting requirements during both the IPO process and throughout its life as a public company. So FPIs are companies with less than 50% of their shares owned by US residents. Domestic issuers, on the other hand, are companies that are either incorporated in the United States or have more than 50% of their shares owned by US residents, and then one of the following three tests. So either a majority of the company's officers or directors are US citizens or residents, more than 50% of the company's assets are in the US, or the company's business is principally administered from the United States. So as you can see from the chart, there are some meaningful accommodations for FPIs both during and after IPO, including in corporate governance, where FPIs can satisfy certain of the SEC's corporate governance standards by complying with their home country requirements. Also, there are certain phase-in accommodations to the NASDAQ's corporate governance requirements. For accounting standards, FPIs can report in accordance with IFRS rather than US GAAP. And in terms of executive compensation disclosure, FPIs are permitted to provide aggregate data on executive compensation rather than individualized detail. For ongoing reporting obligations, unlike domestic issuers, FPIs are not required to submit reviewed financial statements on a quarterly basis to the SEC. They still need to do annual and half yearly, but not quarterly. Another categorization that can provide relief during and post-IPO is that of an emerging growth company. So an emerging growth company is a company with annual gross revenues of less than approximately 1 billion during its most recent financial year. Emerging growth companies also benefit from reduced regulatory and reporting requirements, including notably only being required to provide 2 years of audited financial statements in the SEC registration statement instead of the 3 years that's required for non-emerging growth companies. And most importantly, relief from the requirement under Sarbanes-Oxley that the company's external auditors annually attest to the effectiveness of the company's internal controls over financial reporting. So it is possible to be both an FPI and an emerging growth company, and determining a company's FPI and emerging growth company status very early in the process can help a company establish what information it needs to include in its registration statement, but then also to assist it in planning for its post-IPO life. So in sum, even with the relief provided to FPIs and emerging growth companies, management should expect a significant increase in compliance costs and a correspondingly significant investment of time by management to comply with the ongoing US reporting obligations, particularly because there's an increased exposure of NASDAQ listed companies to shareholder lawsuits or companies listed in the US on the NYSE or NASDAQ. So newly public companies in particular are especially vulnerable to class action lawsuits in the initial year of being public, especially where investor expectations have not been met. So to list in the United States, a registration statement and prospectus will need to be filed and approved by the SEC. The SEC has permitted all companies to request confidential filings. So this means that, similar to the UK, an issuer can go through the entire SEC review process without making the registration statement public or disclosing that it's been submitted to the SEC. However, unlike the UK, following the IPO, all of the SEC comment letters and the company's responses will be made public. Also, unlike the UK, where material contracts are only summarized in the offering document, management sometimes finds it very surprising that in the US, all of a company's material contracts are exhibited to the registration statement. So companies can request that certain portions of material contracts be treated confidentially, but then only on grounds that a public disclosure would result in competitive harm. So an FPI can choose to list its shares or ADRs on the NASDAQ. If a company decides to register and list its shares, they will need to go through a special eligibility process with the DTC, which is the Electronic Securities Clearinghouse in the US. If a company decides to list ADRs, they can do so either as a secondary listing or as part of an IPO. Listing ADRs requires the establishment of a depository program with a US depository. The depository will hold the underlying shares and then issue a separate security, an American Depository Receipt or ADR, which will trade through the NASDAQ. So ADRs are dollar-denominated securities that can be issued to represent a specified ratio of underlying shares in the company. And this ratio can be very useful to help achieve a minimum bid price and to support the trading price over the longer term. Sanjay has mentioned that the market abuse regulation in the UK, and there are similar prohibitions in the US on trading while in possession of material non-public information. Also, like in the UK, as Sanjay noted, shareholder approval is required for certain transactions, including the issuance of securities in excess of 20% of the pre-transaction shares outstanding, or for transactions that would constitute a change in control. In terms of subsequent fundraisers, the NASDAQ listing rules require shareholder approval for private placements where the issuance is going to equal 20% or more of the pre-transaction outstanding shares at a price below a certain minimum price, a defined price. But an IPO process is really all about preparation, and Sanjay is now going to discuss some of the key areas to be thinking about in advance.
Thanks, Roberta. So, as Roberta said, it's all about preparation, and a typical IPO process takes between 4 and 6 months from the kickoff meeting. But even before that time, you should be working on getting your ducks in a row, particularly in the 4 areas I've set out on this slide. So, shareholder buy-in. Before starting a formal IPO process, it's crucial that you've got buy-in from a company's key stakeholders. So VC investors will likely want to be party to all strategic decisions, whether that results in an IPO or an alternative to an IPO. And ultimately, the board and the company's key shareholders, including those with any veto rights, will need to approve an IPO. So it's important that they're brought on side as soon as possible. Valuation, well, this is a big one. So VC investors will often have a minimum valuation or market cap in mind as a condition to agreeing an IPO. So it's important to speak to those shareholders to know what those numbers are and whether they're consistent with the preliminary valuation put on the company by an investment bank. Board composition. So the boards of most private companies pre-IPO typically comprise of a mixture of executive management or founders and representatives of shareholders, typically directors appointed by the lead VC investors. Most of these appointments result from terms which are set out in shareholder agreements, but at the point of IPO, those shareholder agreements will fall away. So it's important to think in advance about the balance of the board, who you might want to appoint as an independent non-exec director, who will be able to provide the requisite experience having regard to the nature of the company's business, but also the fact that it is a public company. And finally, plan B. So the biggest part, I say, of having a plan is having a plan B. So despite any confidential market soundings about interest in the IPO from potential investors that your investment bank may have taken before kicking off the process, there's actually no guarantee at the start of the process that the IPO will ultimately be successful, or that you'll be able to raise the amount of money that you're looking for, or that in the end it's going to result in a company being publicly listed. Even if a company's business continues as expected during the process, things like changes in stock market conditions, the political outlook, or even the broader economic outlook could adversely affect the ability to successfully complete an IPO. In the last 12 months, we've seen IPOs fall over at the final hurdle. So all the work had been done, but when going out to investors, the demand and the interest in the company just wasn't there. The problem with that is a company will, by that point, have incurred a lot of costs to get to the point of speaking to investors. And so it's important to go into an IPO process with your eyes wide open and to be aware of the potential cost implications. To put that in context, for VC transactions, you would only ever pick up the pen and do the substantive work once you've got a term sheet in agreed form. And obviously, once you've got a term sheet, you know that there is sufficient interest to provide that money to the company. So it's a little bit different, and costs are more at the back end in a VC transaction as opposed to the front end in an IPO process. So it's important to consider what a company's plan B will be if the IPO doesn't proceed for any reason. So it could be another private financing round. You could delay the IPO for a period of time, or even opt for a trade sale if certain investors are looking for an exit. Sometimes VC shareholders or the investment bank advising the company on an IPO could choose to run a dual track process. So this would involve preparing for and progressing with a potential IPO, and at the same time running a soft auction process to see if a better result can be achieved for shareholders by the sale of the company as opposed to an IPO. Julian's going to talk now a little bit about some of the key work streams involved in the IPO process.
Thank you, Sanjay, and thank you, Roberta. So we've heard a lot about the eligibility requirements and continuing obligations for the different markets. We've also heard just now from Sanjay about the importance of being prepared for this process, but also for having that plan B in place. On this slide, we're going to look at some of the different work streams and some of the key decisions or issues that will pop up in the context of any IPO, regardless of market. And as I said at the beginning, there's a lot of detail on this slide, and it's very much meant as a sort of takeaway. So if there's stuff here that you'd like to sort of discuss afterwards, please do get in touch with us. If we start off with timing, Sanjay's talked about the fact that the typical IPO will take somewhere between 4 and 6 months to complete. The other key decision that you'll need to take is when in your financial calendar year is the best time to launch your deal. Obviously, investors will expect up-to-date financial information, and they will not want to be investing off the back of stale financial numbers. There are also in certain markets some prescriptive rules. So, for example, in the context of a premium listing on the London Stock Exchange, your last balance sheet, your last audited numbers cannot be more than 6 months before the date of the prospectus. Roberta, there are specific rules in the US here too, aren't there?
Yes, there are. So specific accounting comfort is required in connection with a registered offering in the US, or if a company decides to include a private placement into the US as part of its listing outside the US on the LSE, for example. So this comfort requires that an offering be completed within 135 days of the company's last audited financial statements.
So what does that mean? So for a company with a year end of 31 December, looking at sort of the premium listing in London, they would have up to the 30th of June the following year to close their IPO. But if you decided to combine a US private placement with that same offer, then you'd have to have it done by the 14th of May. And that's as a sort of a general rule. As the slide then says, in terms of the advisory team, inevitably you're appointing sort of a cast of thousands. That in and of itself takes careful planning and will take up quite a lot of time to ensure that you are choosing the right people. I think the key point that we'd make here is don't just pick the investment bank who promises you the highest valuation, because it won't necessarily be the price that the deal is done at the end. It may indeed, as you've heard from Sanjay, fall over, and that of course will end up being your fault. Make sure you choose lawyers and investment bankers who have expertise in the sector. If you don't use a firm that has sort of deep bench strength in life sciences, you'll find that you're having to answer a lot of very stupid questions on a daily basis, which obviously takes up your time. And also make sure you pick advisors that are suited to the size and nature of your deal and your business. So if you are a small growth company looking to come to the AIM market, you won't want to be doing that with Goldman Sachs, for instance. Then in terms of sort of group structure and current ownership, the first question I always ask clients is, what are you actually listing? And is everything within the business that you need to be within the business, or are there bits you need to spin out? Are there any services being provided by sort of major shareholders or assets lent into the group where those arrangements will need to be formalized before the actual deal is done? So you'll need to sort of take that into account as well. You'll also need to think in terms of what shareholder consents or other third-party consents may be required to affect your deal. When it comes to capital structure, you need to ensure that the capital structure of the listing entity is suitable for the market. So in the UK, for example, you would typically expect to come to market with a single class of shares, with everybody having the same rights. And as Sanjay highlighted, any sort of pre-existing special shareholder rights in shareholder agreements would fall away at the time of IPO. Also, if you wish to offer your shares to the public, you will need to ensure that you have a PLC as the sort of the offering entity and the listing entity in that context. So you will most likely have to incorporate a new holding company and put that on top of the operating group. I suppose a question for Roberta is, if I was coming to the US, do I have to use a US entity as my top co?
No, you don't have to insert a Delaware holding company at the top, for example. But if a company does, it will want to consider the consequences of no longer being considered an FPI.
Okay. And in terms of sort of shareholder rights and things, are there different rules in the US in relation to those?
Well, for shareholders that are greater than 10% or otherwise considered an affiliate of the company, they will generally want registration rights. So back to the point about the VC sponsors and other affiliates holding what are called restricted securities. So they will typically require that the company enter into what's called a registration rights agreement that will give the affiliate shareholder the right to require the company to register its shares with the SEC, which is largely at the company's expense.
Okay. And then in terms of sort of corporate governance and board structure, Sanjay's talked about this, but I would say in the context of the deals that we have done this year, and in fact all successful IPOs, it's fair to say that the two ingredients that they all have, one is a good growth story and the other is a very strong management team. And that isn't just the executives, but it is also that sort of professional board that comes in and will be involved with your company sort of going forward from IPO. Diligence we've talked a lot about, so I don't think we need to say much more here other than to flag that if there are housekeeping issues that you need to contend with, the important thing is don't sort of, don't sweep them away, don't hope that those sort of won't be relevant to the transaction. It's always best to discuss those with your lawyers at the outset to make sure they don't come back and cause sort of greater issues at a later stage in the process, because that may just lead to delay. Typically, I'd say that sort of all diligence issues can normally be dealt with. They'll either be dealt with by sort of tidying them up pre-IPO, or otherwise it might be an issue for specific disclosure within within the document. But either way, I've only worked on one deal where a diligence issue actually sort of paid to the transaction. So it is rare. When we then look at sort of systems and controls, as you've heard, given the continuing obligations that you'll have as a listed company and the regulatory regime in which you're operating, it will be very important to have suitable systems and controls in place. These go both to the sort of financial and accounting side, but also disclosure, regulatory and compliance issues as well. So expect to be working with your lawyers, your accountants and other advisory team on these issues. If something goes wrong in the context of a listed company post-IPO, normally the first thing the regulators will look at is whether or not the systems and controls were suitable for the company. And if they find that those systems and controls fell short, you can expect to be on the receiving end of either public censure or otherwise a fine. The last bullet here is in relation to share option plans. Again, you'll want to ensure that your employee workforce going forwards is suitably and appropriately incentivized. So whilst you may speak to the accountants or remuneration consultants who can advise you on the different types of plan and what is suitable for your market, benchmarking it perhaps against your peers and things, please do look to lawyers to draft these plans, because ultimately the lawyers are much better at it than anyone else, dare I say it. So that wraps up our session today. I will have a look to see what sort of questions have come up, if any. But first of all, from all of us, thank you very much for joining us. Please do also visit the Pinsent Masons partner booth, which I believe you will have access to. Thank you.